Were the structural problems of 2008 and the impact of normal business cycles masked with the central planning, buybacks, and financial engineering? And if so, how does that manifest itself once the steroid bottle is empty?
I don't know if the steroid bottle, I mean, capital markets effectively have to close for the steroid bottle to be empty. So there's some data out this morning saying the largest 1,500 non-financial companies in the U.S. have raised over $400 billion in debt, 90 to 95% of which was used for buybacks and dividends.
Wow.
And this is in the last year, last year alone. We've shown this in a myriad of ways in our previous two macro themes decks.
Yeah.
But you have corporations in the U.S. are as levered as they've been. Really, at any time outside of the financial crisis, obviously when you didn't have any earnings or cash flow. But again, so on an economy-wide debt to free cash flow basis, we're pushing at 4x or 4 turns. If you think about corporate credit to GDP, or it's up at about 71%, which we peaked at, I want to say 73 or 74% in the financial crisis. So again, the economy is very levered, and what you're seeing is a lot of leverage go to no investment. There's also a data point released yesterday or today. Global R&D plans are at a 6-year low, at a 3-year low in the U.S. So people aren't levering up to invest or levering up to buyback. But again, what we're seeing is that buybacks are lagging the market.
Yeah.
And I think people are starting to realize that if it's a late cycle, you don't want to be levering up your balance sheet right now. You definitely want to be de-risking your balance sheet and really focusing on sort of organic growth and figuring out a way to sort of maintain your operating margins. Because if we're right on the growth cycle over the next 3 to 6 months, you could look like an idiot.
Yeah.
Levering up to buyback stock here.
There's people are just worried about hitting earnings numbers.
Yeah, well, I mean, they will be until they aren't. I mean, at some point, it's
No, I hear you.
Yeah, I mean, there was
that kid doesn't go on forever. I mean.
Yeah. Well, it's definitely not going to go on forever. So last week, you had the SEC come out and really take a hard line stance against pro forma earnings, and I mean, I don't know if this will be resulted in any legislation over the immediate or to intermediate term, but they're certainly sounding the alarm bell on the widening divergence between GAAP earnings and pro forma earnings. I think for 2015, the divergence was 25%. GAAP earnings were down 25% relative to their respective pro forma earnings on average. This is, the only time we've ever seen that was in coming out of the tech bubble and into the financial crisis.